We need a Fed to become much more friendly than what it has been so far in 2023. And gold will do fine, and gold will do well. And and let me remind you the statement we made at the introduction, that each time the Fed move from a tightening mode to a pause mode, gold goes up by 50%, 50. So I expect gold to hit $2,500 in the next 18 months, 2 years.
In a recent interview, Alain Corbani, the head of mining at Montbleu Finance and manager of the Global Gold and Precious Fund, shared his bullish outlook on gold, anticipating a surge to $2,500 per ounce within the next 18 to 24 months. This forecast contrasts a Reuters poll conducted in October, which predicted an average gold price of $1,986.50 in 2024. Gold prices have consistently averaged above $1,950 throughout the current year, surpassing any previous annual averages. Corbani supports his optimism by pointing to a historical trend. Gold prices tend to rise whenever the Federal Reserve shifts from a tightening phase to a pause in interest rates. Drawing parallels to the 1970s during that period, gold prices soared even as interest rates increased. By 1981, when interest rates had quadrupled to 16%, gold reached an unprecedented price of nearly $2,000 per ounce. Expressing skepticism about the economy's capacity to endure higher interest rates, particularly in the face of unprecedented levels of debt and diminishing concerns about inflation, Corbani underscores the potential for a more dovish approach from the Federal Reserve. The stance of the Federal Reserve, as articulated by Chair Jerome Powell in a press conference, aligns with Corbani's expectations. Powell indicated that the central bank is likely concluding its interest rate hikes and anticipates a shift toward reducing borrowing costs by the end of 2024. The recently released minutes from the meeting highlighted participants' recognition of a decline in inflation throughout 2023, emphasizing the noteworthy drop in 6-month inflation readings. Notably, the phrase unacceptably high was omitted from the discussion of inflation, signaling the Fed's belief that inflation is on a downward trajectory. Just before you watch Alain Corbani's interview, make sure to subscribe to our channel and give this video a big thumbs up.
Gold, we need to understand real rates. We need to understand where the U.S. currency is heading. But now that I said it, it's even more important to make it very simple, straightforward way. We can complicate the approach to understanding how gold behaves as much as we want. But if we want to draw a very simple, clear picture for the viewers, we'll just say that each time the Federal Reserve moved from a tightening phase to a pause in interest rates, meaning stopped increasing its rates, each time, it happened in 2001, this happened in 2007, it happened again in 2019. Each time the Fed moved from a tightening mode to a pause mode, gold went up. So the call that we've had for the last 18 months to say rates are going on, we have reached a peak in interest rates, we have reached a peak in inflation, we have reached a peak in the U.S. currency, was based on the fact that the Fed was going to move to a pause mode. And the fact to be on a pause mode does trigger a higher gold price. And this is exactly what happened in 2023. But it wasn't, of course, as simple as that, because until, all the first half of 2023, nobody knew where inflation was heading. And you had all sorts of bets of positioning, whether inflation was going to go above the 5%, was going to decelerate, reaccelerate. It was all over the map. And to make it even more complicated, in Q3, you had an outstanding growth rate of the American economy. So this made it even more difficult for the common investor to see clearly. The clear vision was to say a restrictive monetary policy will affect the growth in the economy and will force the Fed to pause and ultimately to lower its rates. And this is exactly what is happening, or at least what the market has started to price in the last 2 months of 2023. The market will need to digest the fact that the 4%, 3.5% Fed fund rates expected by the end of 2024 is a very conservative target. The market needs to start pricing in the fact that the Fed is not going to stop at 3.5%, that the Fed will go much lower than that. And this is what the Fed did each time it started a cycle of lowering rates. So imagining a second that the economy can sustain 3.5%, 4% 10-year rates when it's indebted to levels not seen in 4 decades, when inflation is not an issue anymore, is not realistic. So the Fed will lower its rates and will continue lowering rates because the economy is going to continue weakening.
In a recent statement, Richmond Federal Reserve President Thomas Barkin expressed confidence in the U.S. central bank's practical efforts to curb inflation without causing significant harm to the job market. Barkin noted that the central bank is making real progress. He sees the possibility of a soft landing becoming increasingly conceivable. This suggests a positive outlook for the economy, with the hope that the Federal Reserve's measures will bring about a smooth transition. However, Alain Corbani, the head of mining at Montbleu Finance, presents a contrasting perspective, suggesting concerns about a potentially weaker economy. According to Corbani, if the economy slows down more than anticipated, the envisioned soft landing may not materialize. This implies that there could be challenges in achieving a controlled economic slowdown. Corbani suggests that if prices rapidly declined, the Federal Reserve might need to adopt a more aggressive stance in cutting rates. This implies that the central bank's strategy could be contingent on the pace of economic developments and the effectiveness of its measures in maintaining stability. Furthermore, policymakers seem optimistic about the inflation outlook. They cite the resolution of supply chain backlogs, which had previously led to shortages and higher prices. Additionally, they point to a rent decline now impacting the broader economy. The mention of an increase in job seekers is highlighted as a positive factor, making it easier for companies to fill vacancies without resorting to aggressive wage hikes. Let's get back to the interview.
The market is extremely reactive, respondent, and violent. In the U-turns it can take in forecasting the direction of rates. But as it stands today, the market is telling you that the Fed will cut the Fed fund rates by 5 or 6 times. 6 times 25 BPs, that's about 1.5%. More or less. Projection of the FOMC are telling you that they are going to cut their rates 3 times, but not 5, and definitely not 6 times. So from being very conservative, the market now is becoming very proactive and thinking, the Fed will have to be much more aggressive lowering its rates than what it's telling us. So, and the reason is, there are 2 possible reasons. One is a weaker economy. The economy is going to slow down more than what we expect. In that case, there won't be a soft landing. That's what everybody would like to see. And this can shock a lot of people when I'm going to say it, or we could move into a deflation period. Didn't say that for the sake of saying it. I was just looking at the forecast of one regional central bank, and basically if we annualize inflation numbers of the Fed of Dallas, November months annualized would show negative deflation. If we take the last 6 months or the last 12 months of inflation, we see that we are below the 2% target of the Federal Reserve. So there are some metrics that are telling you that could induce you to think the core PCE at 3% is actually maybe the wrong figure to look at. And maybe the next numbers will be much weaker, the 3% or the 2.1% that the market expects for inflation 2 years down the road or 5 years down the road. So if the prices go down at an accelerated pace, the Fed will definitely have to be more aggressive cutting rates. So these would be the main two reasons why the Fed would be more aggressive.
How might Alain Corbani's bullish outlook on gold, particularly his historical trend analysis of Federal Reserve actions, influence investor sentiment and decisions in the coming months? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Surprisingly, around 19.8% of our viewers have subscribed. We're aiming to reach 5,000 subscribers as soon as possible, and your support could make a big difference. Thank you for being a part of our community.